Today we're tackling a problem a lot of high earners face. What do you do when your income is too high to contribute to a Roth IRA? And if that's you, don't worry. This doesn't mean that you're locked out of tax-smart retirement strategies. In fact, it often means you have more options and more flexibility than you realize. You just need to know where to look. Before we jump in, smash that like button so this video gets pushed out to more people planning their financial futures just like you. It really helps the channel grow. If you can't go straight into a Roth IRA, your 401k is your next best friend. For simplicity, I'll say 401k throughout this video, but it also applies to TSPs, 403bs, and 457s. Unlike Roth IRAs, 401ks have no income limits, which means high earners can still make large contributions. In 2026, the contribution limit is $24,500 and an additional $8,000 catch-up contribution if you're age 50 or older. And here's why that matters. Contributions are pre-tax, so you get a tax deduction today. This is important because we all need to save for a day when we won't be working. And we know what the tax rates are today. So if we know what tax rates are today, we can save money today. Second, your money grows tax deferred until retirement, meaning it's not being eaten away by consistent tax hits every year or every time you buy and sell a holding. Now, I know you're thinking, but Jacqueline, this isn't a Roth. You're right, it's not. So let's get back to the Roth benefits. The account with the magic ability to never pay taxes on that money again. Many employers now offer a Roth 401k option, and unlike Roth IRAs, there's zero income limits. That means even high earners can still access tax-free growth. Here's how it works. You pay taxes now, your money grows tax-free, and qualified withdrawals in retirement are 100% tax-free. So if your employer offers a Roth 401k, this is often the first place that high earners should look for Roth-style benefits. Just remember the $24,500 annual limit applies across all your 401k contributions, traditional and Roth combined. And while the Roth 401k used to be rare, that's no longer the case. Over 94% of Fidelity administered plans now offer a Roth option. So there's a very good chance that yours does too. If this has been helpful so far, hit that like button. It really helps the channel grow and lets me keep making videos like these. Beginning January 1st, 2026, there's an important rule you need to know about. If you are age 50 or older and you earned more than X amount in the prior year, your catch-up contributions must be made as Roth contributions. For 2026, the income threshold based on 2025 earnings is $150,000, and this number will be adjusted for inflation over time. Here's the kicker. If a retirement plan allows catch-up contributions and includes high earners subject to this rule, the plan must offer a Roth option. If it doesn't, then the plan cannot accept any catch-up contributions from those high earners at all. So this is a big one. Make sure you check with your retirement plan provider to understand how your plan is set up. If you already have money in a traditional IRA, another option is a Roth conversion. This means making some or all of that money into a Roth IRA. You'll pay ordinary income tax on the amount converted, but in exchange, that money grows tax-free forever. But a word of caution. A few years ago, a woman called me after converting her entire $750,000 IRA in 1 year. Combine that with her salary of about $250,000, and to the IRS, it looked like she earned $1 million that year. Yes, that means taxes on $1 million of income. So for most people, Roth conversions are better done incrementally over time, especially now that the current tax code is set to remain in place for the foreseeable future. However, the pro rata rule may apply if you already have other IRAs with deductible contributions. And that rule can increase your tax bill if you're not careful. So before executing a backdoor Roth, make sure you understand your total IRA balances, plan the conversion properly, and avoid accidentally creating an unexpected tax problem, should you bother with non-deductible traditional IRAs. The short answer is it depends. As Rob Williams from Schwab puts it perfectly, non-deductible IRAs don't give you an upfront tax break, and the gains are taxed as ordinary income later. Since long-term capital gains rates in taxable accounts can be lower, sometimes even zero, a taxable brokerage account may actually be the better choice. Taxable accounts are often overlooked, but for high earners, they offer huge flexibility. Long-term capital gains are taxed at 0, 15, or 20%. ETFs, index funds, and individual stocks can be extremely tax efficient. You can use tax loss harvesting, which you cannot do inside of your retirement accounts. Municipal bonds here may also offer interest tax-free. And this is excellent for estate planning, thanks to the stepped up in basis that can go to your heirs. There's also no early withdrawal penalties, so if you're thinking about retiring before the age of 59 and a half, taxable accounts can be a critical part of your overall plan because you'll be able to take that money out without penalty, unlike your retirement accounts. The real power move is using all three tax buckets: tax-deferred, tax-free, and taxable. This creates tax diversification, which gives you more control over your taxable income, your withdrawal strategy, and your retirement cash flow. No matter what future tax rates look like, flexibility always gives an advantage. When Mark and Linda both retired at 62, they thought they had done everything right. For over 30 years, they were diligent savers. Every raise went into their pensions and their 403Bs. They maxed out contributions, followed the rules, and trusted that retirement would be smooth once the paychecks stopped. When retirement arrived, they ran into a problem they never saw coming. Every dollar they could access was taxable. Their pensions were fully taxable, their 403B withdrawals were fully taxable. Even small withdrawals pushed them into higher tax brackets than they expected. When they added Social Security into the mix, more of it became taxable too. They weren't spending extravagantly, but their tax bill felt like a second mortgage. Because all their money lived in tax-deferred accounts, they had no flexibility. No tax-free bucket to pull from in higher income years, no taxable account to smooth out withdrawals, no way to control how much of their income showed up on their return. That's when they realized the mistake wasn't saving, but it was having only one tax bucket. Mark and Linda didn't need more money, they needed tax diversification. And that's a lesson many retirees don't learn until it's too late. So even if your income is too high for a Roth IRA, you're far from out of options to increase your tax diversification. From Roth 401ks and conversions to backdoor strategies and smart taxable investing, high earners have powerful tools available. If this video helped clarify your options, make sure to like, subscribe, and ring that notification bell so that you never miss a strategy to build your financial future. Thanks for watching, and I'll see you in the next one.